Hello and welcome to our first water cooler for a little while. So we've come back because we are promoting the release of this year's Goodwill Report, which we release annually. Now, the best thing about this report this year is it actually gives a 10-year overview. So it's a really interesting overlook as to what's been going on in the market. And to an extent, I think sort of puts to pay some of these urban myths that are out in the market about the dental practice market being a bubble that people are waiting to pop, because what the report does say is that you see there's relatively sustained but modest growth over that kind of 10-year time frame. Would you say that's an adequate summary?
Yeah, I guess, look, I've been doing this for 10 years now, and when I started in the market, I always remember people talking about a multiple of 6, and then we went to the peak times of where Dentex and Portman were fighting for practices, and where there was a lot of consolidation and a lot of groups looking to acquire EBITDA quickly, and all of a sudden multiples batted around turned to 8 times, and that never really transpired into average deal multiples, but you could get 8 times for the right practice. And then if we go to the current multiple, which is 7.14 times and on average into 2026, and we look forward to 2027, where expected to be 7.34 times, it's moderate growth year on year. But there are some outlying years due to COVID, recessions, etc., and interest rates, namely 2026, where the multiple slightly softened.
Yeah. So look, we're not going to read all the contents of the report for you, because you can download the report by clicking the link at the bottom of the screen. But I guess there are some interesting points which I guess we just want to deal with. So the first is that you'll notice that the average deal multiple has actually fallen slightly this year. Now I caveat that, but it's fallen 0.02 of a point. So we've gone from 7.16 to 7.14, which arguably is within the degree of error. But then actually the average purchase price has gone up by 7.5%. Now, in theory, you'd say, well, those two things conflict. Now, first of all, when I'm talking the EBITDA multiple, I'm talking just those practices that sold to groups. But also, when we're talking purchase price, I think what the report does talk on quite a lot is how actually a lot of deal value is now being achieved actually through rising levels of EBITDA and rising levels of revenue. So actually, they're not conflicting. It's just understanding, if you like, the depth between the numbers. And there's a couple of other points like that as well.
Yeah, look, I guess on multiple terms is what the report doesn't go into is individual deal structures, for example, and multiple and the multiple achieved is only one element of a deal. And it's, don't get me wrong, it's a very important element of a deal. But one of the most important elements is deal structure. So when we break down the actual deals agreed and we look at how many deals were actually agreed with a deferred element, it only represented 11% of our deals. So I guess the misconception is that the majority of practices are sold to corporates, of where 70% is paid up front and 30% is deferred. Now, them deals are still out there, more at the top of the market, but what we're more seeing is competitive tier 2, 3 and 4 buyers offering good EBITDA multiples, but giving 100% on upfront, which the argument for sellers is that deal is a significantly better deal than maybe achieving 7.3 and having a deferred element.
Yeah, which is arguably a slight discount in the multiple, which may be one of the reasons why multiples have fallen this year, when in practical terms, actually, they probably haven't if you look at all the offers that were presented at the point they chose which offer to accept. Now, the other thing which you could take away from this report, which I think is also potentially misleading, is that the average multiple on an NHS practice has risen to 7.68 times, which is bigger than the multiples for mixed and private practice. Now, again, I think that's slightly misleading, because the first thing I think to remember is that there's actually very, very few big NHS practices nowadays, because big NHS practices mean more than 80% of their revenue would have to be NHS. And actually most practices now have moved towards presenting more of a mixed profile of income. So it means that particular pool of data is quite small. And I think when you do get a big NHS practice now, a lot of people are really interested in it, because actually it shows that there's so much untapped potential. So it's not unusual to get a multiple that is really high or significant in those situations, because people take the view that actually they can probably easily unlock 100 to 200 grand's worth of private revenue if you've got a 600 grand NHS contract, if the practice is in the right area. But I guess what I don't want people to take away from the report is if you've got a practice which is predominantly NHS, so say in the realms of 65 to 80%, which falls underneath that NHS margin, that you think the multiple is going to be bigger than it is, because actually in practice you've already started to unlock some of that potential, which means you wouldn't necessarily receive that extra, if you like, Goodwill premium on exit.
Yeah, and just one of the final points is it's just really key to note that all of this data is from completed deals that completed in 2026. Now, a large majority of them deals were agreed earlier in the year. So even in 2025, average deal time is 9 months. So a lot of the deals and multiples that were agreed were on the basis of where interest rates were slightly higher, where there wasn't a competitive market is in terms of lending, of which has really changed over the last 6 months, which we do think is going to massively impact multiples, and that's already showing in our projected 2027 figures.
Yeah, which we've included in the report, and we've also included the forewords from the guys in DE Finance talking about the different kind of lending opportunities that are out there in the market. So I guess just to close off, obviously we focus quite a lot on groups, and the independent market, which still represents about 69% of the transactions that we do, is also still strong. So this year, the average deal value on an independent sale was just under 890,000, and the average EBITDA, FMT multiple, because we use a different valuation methodology, was around 3.4, just north of 3.4, which again, is strengthened and strong, and again, probably representative of the really competitive lending climate at the moment.
Yeah, well, we expect that to go up again, and that's on the basis that now buyers out there aren't having to put in the same quantity of cash. So most buyers looking to finance a practice can now achieve 90-95% LTV, which means that they have to put in less cash, which means that the asset is probably a bit more desirable. They'll be willing to pay a bit more. So again, we expect 2027 to show even stronger multiples moving forward.
So there you go, full report available on the link. But if you've got any questions, feel free to drop one of us a line.